I was going to say, why don't we go ahead and kick off, and then as people come in, we can go from there. I have a little bit of an intro that'll give us an opportunity, and we can go from there.
Perfect.
Alrighty, welcome everyone. It's a pleasure to have you here with us today as part of our new program, Open Access, brought to you by Open Houston. As you may be familiar, Open Houston's mission is to advance the Houston entrepreneurship ecosystem by connecting entrepreneurs, investors, innovators, and experts across a variety of fields. Open Houston is a chapter-based organization that is steered by an esteemed group of charter members who through their success are sharing and creating opportunity beyond themselves. I see so many of you here with us today, and we thank you for all that you do. This marks our second event of our new series called Open Access. We call it Access because it's all about opening doors to people, opportunity, and expertise. This is part of a repeating series that'll take place on Thursdays at 5 p.m. And this week, we'll be talking all things real estate with Shadow VC. We have Nick Durham, who leads Shadow's Fund and Business Development, and Anastasia Simon, who leads Shadow's Accelerator Program. As a heads up, next week, we will reconnect with Incentifine CEO Natalie Goodman. As you know, Incentifine came in second place at Open's 2019 conference and pitch competition. And Natalie will be sharing how she has built her company since then, how she puts money back in the pockets of property owners and developers through sustainability, and how she's intelligently leveraging debt as a way to capitalize her business. All right, let's get into it with Nick and Anastasia from Shadow. You guys are focused on changing the game and how we purchase, build, and manage our built environment. So without further ado, let me hand it over to you.
Thank you so much. Anastasia, I am going to just run straight into our presentation. So was hoping that you could give us a warm introduction, and then I'll just kind of take it from there.
Okay, that sounds good. So real quick, and my dog is barking, ignore him every day. I'm going to give you a quick intro on myself. So I've been with the firm for about 3 years now, since its inception, and my focus has been managing first our incubator, and now, as Shafiq said, our green building accelerator. And so as a senior associate with the firm, it's just been an interesting ride learning more about VC. Nick is going to dig into a little bit more of like our thesis and why Shadow is different than maybe some of the other VC firms that you've heard of. But so I'll just let him kind of go there, and because you're going to give a deep dive, so I want you to kind of go in and give it to us, you know?
Perfect.
Yeah.
And then once I get through, so I'll first give an introduction for myself. I'm Nick Durham. As Shafiq so gratefully mentioned, I kind of manage our fund. So specifically, to give you more detail on that, we are a Proptech focused venture capital firm, and we've essentially opened up and launched our first fund vehicle. It's a seed stage fund. So for those who are newer to venture, kind of what we mean by seed stage is very early stage development of a company. We kind of liken it to when you're actually building the car versus putting the gas on the car or adding features. Those are kind of later financing rounds. So kind of fundamentally, a startup that we would look to invest in, they are still kind of figuring out the mechanics of the car. They're putting the foundational pieces in place. And usually at that stage, almost every technology startup needs a little bit of capital to get going. So that's kind of the fundamental idea for why venture is, equity funding becomes pretty important early on for some of these companies, especially the more technical companies. So we look to provide that funding. There are a number of different things that we look for because we see a lot of early stage companies. So we'll definitely address that. There are certain qualities that I think that we look for when we are evaluating a startup that are kind of fundamental and really important when we're talking about diligence and analyzing kind of the financing opportunity. But also, as I mentioned, so seed stage, we also are a PropTech focused VC, and so let me just give you a little bit of overview on what that word means. For us, it's actually pretty broad. For a lot of people, it's very niche. PropTech for us is any technology product that's innovating how we design, build, and operate the world's physical infrastructure. So could be an office complex, could be a multifamily asset, industrial. We also are interested in investing in things that are supporting our horizontal infrastructure. So bridges, roads, airport infrastructure, all of those things that make up what we kind of label as the built environment. That is kind of our purview for investment. And when we talk to folks that are outside of that are working professionals outside of real estate or construction, or even in engineering, the first question is like, why should I care? Why is PropTech interesting, or why is it fundamental? I mean, you're talking about the places that you work, live, play, interact with family and friends in, right? So all the world's physical locations. We could of course run through endless examples of why that piece of our world is valuable. But I think inherently we all understand that. I mean, it's not just capital markets of real estate. I mean, we're talking about supporting a large percentage of our economy, whether it's construction, new construction, new development, supporting existing developments. All of these things are things that get us really excited, because we know these are some of the most foundational things to our existence as humans, right? So the world's maybe the last physical artifacts remaining in the world are the things that we support. So fundamentally, we think it's a pretty important space to invest in from an ecosystem perspective. But also what I'm going to jump into next, it's a fantastic venture capital opportunity, because when you pull back the curtain on from a technology adoption perspective, and anyone who's in real estate on this call will understand this, major laggard, the entire space, like just way behind in terms of its software adoption, digitization. We're talking about a large percentage of our economy that like largely hasn't embraced tech, and there's a lot of reasons for that. Some of them are better than others, like integrating tech into a physical artifact is a lot more difficult than running a software program that consumers can interact with on their phones, right? I mean, we're talking about like getting into the core infrastructure of the building, the facilities, the energy management, access control. There's a lot of moving pieces here. And so I don't mean to say that as an excuse, because obviously we don't believe that that's an excuse for why we're behind. I'm just saying it's a little bit more difficult, and there's a reason why, right? So let me kind of jump in. I'm going to share my screen and kind of jump into our presentation here. So here we go. So what we label as the built world, the built environment. I'm just going to run through a couple quick stats here. So I alluded to the size. So it's a $40 trillion asset class, and kind of by asset class, I mean largely our real estate. So the culmination of all of our real estate assets in the U.S. alone is roughly $40 trillion. Annual spend, this represents mainly construction. 1.4 trillion. So roughly 4% of US GDP is entirely devoted to the space that we invest in. Yet, we've just talked about the magnitude here. Only 1 to 3% typically, oftentimes way less than that high end of 3%, is devoted to annual spend in the technology and R&D space. So little commitment to investing in technology, to investing in new business protocols and new business models that could serve to be very valuable in the long run. And I think that stat right there just it speaks to the low amount of risk that a lot of corporate stakeholders in our space have taken and have approached their assets with. They're just very risk averse. And then, of course, the glaring stat here at the bottom, McKinsey's released a lot of studies in our space. Second least digitized sector in the world. The first, if you're wondering, is hunting and agriculture. So pretty embarrassing stat, given the size of it, and given how important it is to our economy. It's like we should always, with something this large, we should always be striving to enhance productivity and make sure capital is allocated in the right ways, right? So the next question from a venture perspective, and again, for those that are new to venture, kind of the idea is we invest in technology companies before they're very attractive to the market. So we get in early when they're building the product, and the goal is over time they become mainstream. They scale very well, and eventually they IPO or they have a massive exit to an existing corporate who's an acquirer. So you're kind of you're betting in the dark a little bit, but you're trying to get predictive with trends, and look for signs that a market and the sector with which you're investing is on the scale of disruption, right? It's on the verge of disruption. So a couple of the things that we've noticed about the built world that make it an interesting investing opportunity for us, the thinning margins. So every business in this space, like largely they're largely services companies. So you look at architects, engineers, contractors. These are like pay for fee, pay for service businesses. So you're talking about margins that are and sometimes less than 15 to 10%. And when your margins are that tiny and you're competing with tech companies now that are producing margins that are way, way higher than that, it kind of forces you to do something. It forces you to act. The labor shortage, there's a massive labor shortage, specifically in construction. Very few young people from our generation, no one's really attracted to or excited about going to enter the construction space. I think engineering, you can make the case that that's still an attractive career, but largely the architecture, engineering, construction space has given way to young talent that are looking for more quote unquote sexy technology jobs. So they're moving to the Bay Area. They're working for the best software startup, and our space is left kind of in the dust with a major shortage to take care of. Abysmal productivity. Actually, productivity in the built world has declined since 1968. It's one of the few industries where, like, even though we've been innovating. I'm not even talking about software, like just basic innovation of tools allows at least a modest increase in productivity. Our productivity has declined, so that has to be made up for in some form or fashion. And our buy into all these answers is technology is kind of the answer, right? So the next would be the environmental crisis. We touched on it at the beginning of the call. There's what happened in Houston is an interesting topic related to energy conservation, renewable energy sources, et cetera. But largely speaking, we're looking at the macro trends from a top-down perspective. At the federal level, at the state level, and at the municipal level, there are now mandates that real estate stakeholders have to abide by certain carbon emissions laws and reduce their carbon footprint. So if that's the case, we're talking about these old school physical artifacts that aren't built to be energy conscious. How are they going to make that transition, right? They need tech to do that. Ubiquity of tech. Everyone has a smartphone. Lower price of tech. Tech's deflationary. Cost has gone way down over time, which is influencing viability and adoption rates in a positive way. Mainstream capital has entered. What I mean by that is like some of the bigger name VCs are now targeting our space. Your Andreessen Horowitzes, your Sequoias, your SoftBanks. They're all existing. They all have equity ownership in existing assets within our market. The other thing is proven market adoption. So adjacent markets have tried out technologies such as 3D printing, IoT, robotics, autonomous equipment, obviously software that is digitizing a large aspect and a large footprint of the total economy. A lot of these trends have occurred and been successful in other markets, and there's a nice path to do it in our space as well. So those are some of the things that we're looking at and paying close attention to. Just to give you a kind of a concept of our fund and how we're using that information to go make to go make investments into early stage startups. Our Shadow Ventures, we've built a team of former operators of early stage startups. So a lot of startup experience kind of within our firm. In fact, our belief is if you're investing early stage and you're a VC, you kind of really have to understand what the daily grind of operating a startup is like. You kind of hear in VC, you hear horror stories about investors who are completely out of touch with what it takes to build a startup. And so, there's a large discrepancy sometimes between what you're going to get from an investor and what the startup, one, is capable of. And then two, there's like a large amount of miscommunication that can happen if those two things aren't married. So we think like if we're going to invest early stage, we have to have done this before. We have to understand, the kind of the inner workings of the company and what success looks like. And we can pass on a lot of those learnings and our experiences to the startup that we've invested in, when we have kind of our weekly or monthly conversation. So that's really important from an advisory and portfolio support perspective, is that you've kind of done this before. And again, myself, Anastasia, and pretty much every member of our team has. We also are a little bit unique in that we pursue early liquidation. So one of the drawbacks of early stage investing is it takes a very long time to exit that investment. It's highly illiquid, right? You're talking about, if you're an early stage investor in Facebook, or in the news this week, Coinbase, they're scheduled to IPO. A lot of times these are 7, 8, 10, 12-year holds of an investment where you have zero access to liquidity. So that's a big turnoff for a lot of investors. And for our industry, our goal is to incentivize investment, right? We want corporates, we want industry professionals to have skin in the game into early stage tech companies. And so, one, our belief is we want to incentivize that. So we're going to pursue early liquidation and sell our position early to other investors when it makes sense for us to do it. So from an IRR perspective and a return perspective, it's got to make sense for us to return to hit our target numbers on the fund. But also, I think the other thing to mention here is, from an early liquidation perspective, there is a lot of benefit to providing liquidity to mainstream investors who can actually come in and help beyond where we can help. So we're really good at building the car, like I mentioned. We're admittedly, like, we're a small firm. We're not great at getting scale. We're not Andreessen Horowitz. Like, we're not great at taking this thing to the masses. So if we can sell our position to someone who can, maybe keep a little bit of upside in the deal, but return a large percentage of of those funds to our investors and making sure they're getting cash relatively quickly, we think that's a pretty winning approach in our market. One of the questions we get often is like, where do you find your deals? Like, how do you find startups? The biggest place that we find them is through our incubator program, which is called Shadow Labs. And right now we have about 70 companies that are specifically building in our market. They're building globally, and they join our incubator. We have monthly calls with them. We essentially support them, kind of in foundational ways before we would write a check. And we try to hold them accountable for some of their goals. So typically these companies are they join the program prior to where we would invest. We track them. From our perspective, we get to know their teams. We de-risk the investment, which is obviously, when you don't know people and you're making a 10-year investment, that ends up being a pretty important part of the process. And our incubator helps us do that. And we're known in the market, a lot of PropTech focused VCs. And so with that label, I'll mention a few real estate focused PropTech VCs. They tend to be more industry focused before technology focused. We're the exact opposite. Our team kind of comes more from a technical place. We look at things through a technical lens before anything else. We have a full-time CTO on our team who does code reviews when we're looking at evaluating investments. So from our perspective, that's a really, like, you're buying, you're investing in people and you're investing in the product. And if you don't have a team that can understand what the code base looks like, what like where the product is, on its roadmap, and they can't get in the weeds to do that. And you'd be surprised how many firms don't have that ability, even though that's a large percentage of what they're investing in. We think like that's just kind of a lack of diligence and really not appropriate. So that's an important piece. I think like I'll kind of brush over, unless anyone has specific questions on our fund size and some of our return targets, we can cover that, but not meant to be a conversation there. So I think one of the questions we get frequently is like, what does an investment look like in your space? So let me just give you some examples. So drone surveys, so literally, like, you can imagine a drone flying over a job site, flying over a skyscraper, taking video footage and photography of the existing asset and getting real-time kind of feedback to the stakeholders that aren't on the job site or can't, they can't view the building in the way that they would like to, or as frequently as they would like to. So there's a lot of things happening from a visualization perspective in our market. And when you talk about the kind of some of the shortcomings in technology in our space, we're talking about largely just like poor project management, right? We're talking about productivity. It's like these projects are going way longer than they should, way over budget. Look at any airport built over the last 10 years. I'm in Boulder, Colorado. Denver, just down the street, has been a disaster of an airport project. Kind of seeing that real time has been pretty insane. We're talking about millions of dollars of cost overruns just this far, and years of delay. Anyone who's built a house or renovated a house, I'm sure, can speak to this. Like, generally, the project's going to take a lot longer than you're originally told, and it's going to be more expensive. So those are the two things that I think like we're trying to solve for. And if you take a step back and zoom out, you do that. You do that through tech and through accountability and through data, right? Through visualizing what's happening on the project. So a lot of times you get some superintendents will get told one thing is happening on the site, but they're not there. They're at another project. With drone footage now, you can't miss what's happening. You're seeing this real time. So I think that's a really interesting kind of component. And broadly speaking, like those are the two items that we're solving for. Smart building technology. So understanding the energy footprint of the building, utilizing the space more effectively, managing water, waste, and energy. Those are some things that we look at. Access control, I think, is a piece there. So if you've ever entered an apartment building just with your phone, either facial scan or a QR code on the door. A lot of multifamily properties have this tech now. That's an investment area that we're interested in. Property tech, so a lot of fintech applications. So residents paying rent, property management via software. So if you own multifamily properties, how you manage your tenants, how you manage your entire portfolio can be done here. Modular and offsite construction. So this is a really interesting, we talk about productivity. Basically, the future of construction points to kind of everything being built within a factory. So it's called prefabrication. You build everything in a factory and essentially ship it to the site. Well, obviously a lot of hurdles there, but you get the project done a lot quicker. So we would invest in picks and shovels tools that are supporting those, are supporting that industry. We wouldn't go out and invest, let's say, in a modular company, because that's not enough technology for us. Sustainability and clean tech, I think, is the last category here. And Anastasia is going to cover this in depth, so I will leave that to her. Some nice visuals for some of the tech we look to. A large part of our prior track record, should cover this really briefly. We've really only invested in this market. So we're committing to staying here. This has been our pure focus since our existence. We've had 2 exits out of seven deals so far. And we were just founded in 2017. So we're a very young firm. So having 2 exits under our belt is a pretty decent result for kind of where we've started. I think one company I wanted to point out on a prior track record that might be interesting here, it's a company called Icon 3D. They do 3D printed housing. So they're solving a computer vision problem. They're doing 3D printing. There's a robotics element, material science element. They're really trying to solve the affordable housing crisis by making a 3D printed house way more affordable than your traditional stick home. And they're based in Austin, so I'd be curious if some of you have heard of them. But they're growing very quickly. They're kind of all over the news. NASA, the Department of Defense, are some of their early customers. So apparently, there's a plan to have a 3D printed home on Mars, and it actually might happen before we get one anywhere near Houston or Colorado. So I'm a little bit bummed about that, but if NASA's paying the bills, I think that's okay. It's okay by us. I'm going to cover this really briefly, and then I'm going to stop, and I'll open it up for questions, and then pass the mic to Anastasia. But I think, like, when we talk about investing and being a successful venture firm, I think there's a couple of things to think about. So if you're curious about angel investing or investing in a fund, I think these are important things to evaluate when you're looking at it. So I would say you need to, like, VCs and investors need to swallow their own medicine and leverage technology, and we think community as well, to de-risk investments. What we mean by community is being able to send out a deal potential or potential deal to someone within the network that understands the deal better than you, right? No chance if you're angel investing that you're going to be the world's foremost expert on every deal that you see, and you need to rely on other experts that are in your network who can help you out with that. So that's a big part of being a successful venture firm, is having one community and leveraging tech to kind of get to get feedback, and to bring a data-driven and quantitative approach to your investment activity. I would say, so kind of secondly, like, for us, you need a way to get deal flow. If you're an angel, how you're getting deal flow and how you're getting into deals is the thing. Maybe it's just friends sending you deals, but to get into really hot deals, let's say it's like a Clubhouse, for instance. I'm sure everyone's kind of heard about the investment Andreessen made in them, and just some of the traction they've been getting. You need some competitive advantage. So how are you sourcing your deal flow? How are you attracting hot deals? And we do that through our incubator and support kind of through that program. So I think that's an important element. The other thing is, like, make sure you're investing in real technology product companies and not tech-enabled services, right? So things that actually give you technology margins, purely from a P&L and EBITDA perspective. Something that can give you more margin than your construction company or engineering company margins, your service-based businesses. And because those companies not only are going to give you better operating leverage, but they're going to give you a higher return multiple. So I think when you're looking at technology investing, our thesis is, like, stay away from services businesses. They can lure you in because they're easy to understand, but you're just not going to receive the back end multiple that you probably want. We've covered entrepreneurs and operators and how important that is of forming a firm. And this is a little bit controversial, but we believe follow-on investing is mostly lazy. We think that when a venture firm decides to follow on, there's probably less analysis that's done on that follow-on investment, even though they're investing more capital than what they previously did early on. And our theory is, like, the risk reward from making another seed investment, from our perspective, is probably better than following on with more capital in a deal that we're already in, just to keep our pro rata. So there's a potential discussion point there, but I will stop here, and I will open the floor up for questions, and then Anastasia can kind of take over.
Thank you so much, Nick. As we're opening it up, that was a very in-depth, overview of not only real estate and how you guys see it, but also where it's going. as the mics are getting turned on for others, I was curious about what's one of the areas that you're really excited about as we look forward in prop tech.
Yeah, it's a great question. I think that, for us, the green building space is certainly of interest. I mean, we kind of we first look for macro trends, right? So ESG, federal, state, and municipal mandates are requiring buildings to get to, to carbon neutral, or net zero. That's a big lift, and we're talking about in like a less than a 10-year period for a lot of these companies.
Yep.
So, in terms of adoption, they're going to have to do something. They're going to have to invest in tech. So we think that that's like a clear area that we're paying close attention to. There's a lot of I think Anastasia will cover this, but like there's a lot of fear of investing there. If anyone followed the Cleantech 1.0 cycle, a lot of people got burned. There were a lot of broken promises from technology businesses that were going to, bring renewable energy sources and do this and that and change our carbon footprint forever. And they really didn't live up to those promises. So we think there's a lot of reasons why this time is different, obviously. And I think so. Anyway, I think that's something to mention. Secondly, I think, so real estate, just to be blunt about it, has faced arguably the most difficult challenge from the pandemic, right? I mean, we're talking about our physical assets for the first time being largely shut down and they're not able to be utilized kind of across the board, from stadiums to office space. The one asset in real estate that was largely unaffected was multifamily, because people's homes. And so we've seen this shift in the capital markets of investors looking to invest more in multifamily and kind of de-risk their office portfolio and their retail portfolio. So that's an area we're really paying close attention to. And I think there's in terms of multifamily tech, there's a lot happening in resident retention, resident engagement. How can I brand my property appropriately? How can I get more operating margin from a facilities perspective out of my property? How can I make it more hygienic, right? That's been another major trend from COVID is what are you doing from an access control perspective? Like, I don't want to touch that door. I don't want a maintenance person coming into my apartment. Like, that's a hazard. So a lot of interesting trends in multifamily. I think that's another area I would say we're focused on.
That's a really interesting point. Yeah, I love the point about sustainability as well, because people are more concerned about the environment. It's starting to become part of what all companies need to do. And I think it's something like, most assets are around, like the average year is like 40 years old in the US or something like that, in that 30 to 40 years old range. And, as you mentioned, the only way that they can really do it is through technology.
Yeah, absolutely. Love that.
Nice.
Looks like we got a question here from Syed. How do the next round investors view early liquidation by seed investors, especially if these are VCs? Does it not hurt the company's valuation or have a negative signal about the investment thesis? Great question. That is largely the biggest barrier we face to executing that strategy. And it's mostly a perception thing. I think the thing that we're worried about most is the negative signal that we're bailing because the startup isn't performing well. So the key thing for us to do is we have to set expectations with the startups, with the current investors. We set expectations up front that this is what we do. This is just our strategy. Then there should be no negative signaling. If a firm is not familiar with us and they come in later and they're like, who are these guys leaving and jumping ship? If we have that conversation with a lot of parties at the investor table and the startup founders themselves, they can communicate that on our behalf, even if they're not buying our stories. So it ends up being a communication challenge. Most startups that we talk to, like, they have zero qualms about this, which is kind of interesting. it actually, and with the evolution of secondary markets, I think this is an interesting thing too. It's becoming more and more common for one employees and existing investors to use secondaries to sell shares at later rounds. So like the veil is being lifted here that this is not a kosher thing. And I think it's becoming a little bit easier for people to swallow, and they're not just reading it as a negative signal if someone's bouncing out. I think the other thing to mention is like very rarely would we take all of our equity out. So we're not, we would still have some upside there, which I think shows that even though this is our strategy, we still have conviction.
Nice. Christopher, you want to ask your question about transportation?
Great. Yeah, sure. So I saw buried in, I believe, under the sustainability/cleantech bullet point on your investment scope, you mentioned transportation as an area of interest. So moving forward, like what interests you in transportation, like right now and perhaps into the next few years?
Yeah, I think we are seeing there's a ton going on in the EV space. I think for us, we're asking ourselves like, how does EV fit into commercial real estate and also commercial construction. So I think EV is largely an area of interest within the transportation sector. I also think that so a company that we're invested in right now, it's a company called RN, and they do like visualization of bridge inspections. So they basically show you via drones, via photogrammetry, small cracks that you're getting in your physical infrastructure. So if a bridge, inspectors are walking it, it looks like it might be an older bridge that needs to be inspected and examined a bit further. They can get way more granular with the accuracy of inspection, and also save a ton of time from like literally people are walking below bridges. Like that's just not an efficient process to ensure the safety of a lot of people. So the other transportation piece I think is like horizontal construction, monitoring our physical infrastructure and our transportation infrastructure, because by the extent of your question, Christopher, I'm sure you're aware of this, like our physical infrastructure here in the US is largely in poor shape. It's deteriorating. We're not doing a whole lot from a technology perspective to support advancements in one, recreating better infrastructure, or two, kind of shoring it up and fixing it. So I think those are just to give you a couple specific. There's other stuff out there, but those are kind of two areas that I think are interesting to us.
And Nick, to that point you're making about infrastructure and EV, if tomorrow every car manufacturer decided that they're switching to electric, we don't have the infrastructure for charging. There's no there. You need to have charging at the same ubiquity level as gas stations for that to make sense. And then when you think about that, that also goes into impact on the grid and all of those things. And so there's a lot of stuff I think that that I'm seeing, particularly on that climate tech side, that's incredibly interesting and does dovetail into commercial real estate. That could be, something that we're looking at, and things that fall into this fact on the green build side. We have another note. Oh, that was just somebody saying thank you.
Thank you.
I thought it was another question. I was like, oh no, they're just saying thank you. So you are welcome.
Do on that note, do you want to shift over to the Cleantech side over there with you, Anastasia?
Yeah, let's do it. So I mean, Nick kind of did a really good job of making the case for why the built environment, why we look at it. A lot of the things that you're seeing for sustainability, or in what we're calling now climate tech, those are the things that are still those same kind of drivers. The ubiquity of technology, you're getting more mainstream investors kind of coming into that space. What that looks like for us is, the built environment contributes 40% of greenhouse gas emissions globally. The built environment is using up about 40% of raw materials globally. And then also when you think about it, if you are a real estate investor and you are in a coastal area, for example, that's going to have a huge play when we talk about rising sea levels, when you talk about things like hurricanes. You know, you guys are in Houston on the Gulf Coast. When you talk about fires in California, your real estate itself, the physical asset, is at high risk, you know, right now when we talk about that. And so if we're not doing something to mitigate the impact of climate change, outside of the fact that you now have regulations coming down from the federal, state, local level that are actually going to force you to innovate, you have to do something. Like it just it's a little bit it's a little bit ridiculous to think that you can't. And so that's kind of, you know, the thing that's the driving force behind that. You know, again, we're investors and we see this as an amazing opportunity. Nick also alluded to Cleantech 1.0, which kind of like peaked in 2011. And that, I think the difference between what you saw then and what you're seeing now is that at that point, things were heavily focused on just the energy sector. So it was a lot of things like solar and things like that. Right now, we need a dramatic decarbonization of every industry. It does not matter what industry you're in. For us to get to the goals around the Paris Climate Accord to actually slow down warming, every industry is going to have to innovate. Every industry has to think about how they're going to decarbonize, how they're going to get to net zero. And so it's a very different kind of ball game. And then again, you have like Larry Fink sent out his CEO letter for the past like 3 years, and it's all about sustainability and ESG. So, you know, if you're not on this wave, you are probably not going to have a business as we round out the next this decade. Like this decade is crucial when it comes to, you know, to what's going on with on our planet as an environmental crisis. But then again, it does make, you know, financial sense. So to that end, you know, our focus again is seed stage. And what we find with the startups that come into our incubator is that they need a little bit of capital to get them to seed stage, because there's kind of that gap that they're in that Goldilocks area. And so we came up with our accelerator program. Right now, we're running a cohort that's focused on some of that tenant retention in multifamily that Nick mentioned. And we're kind of moving into green building. We're actually doing the raise and we're going to be launching that in the next couple of weeks. That kind of focus there is going to be really us working with those startups to get them the traction they need to move the needle so we can do their seed investment. We're going to give them a little bit of capital at the onstart of the cohort, but then we're also going to kind of come back and do their seed round. And that's really kind of how that works. We have about 7 venture partners who are part of that program. One of them is the Chief Sustainability Officer for the Home Depot. We just landed him yesterday. And it's a great panel of people who are from industry, who understand not only sustainability, but understand the built environment and the challenges that we're facing. Nick, are there some things, because I know we're getting tight on time, so I don't want to dig too deep. I know there's a lot that we can kind of go into, but are there some things you want to kind of call out specifically around the program, or
Yeah, I mean, I think it might be worth mentioning the kind of our strategy and why we're doing it and how it like fits into our system, like, you know, because like, and I'll let you take it from here, but basically there's a stage where we get sent a lot of early stage deals that are just they're immature, they're green deals in the sense that they're just like very young companies. Mm-hmm. And we have to, we like the idea, we like the founders, and there's always been a gap for us, mm-hmm. In terms of, you know, kind of working with them. So I think Anastasia, if you could speak to that a little bit, that'd be.
Yeah. So to that point, like you just mentioned, we do get a ton of great companies that are, like you said, it's a Goldilocks area. They're a little bit too early. They need a different amount of coaching. They also need capital because they need money. What startup doesn't need money? Yeah. So the way that we kind of look at it is that, you know, for us, the process really is, you know, they come in, we work with them, we get to know them, we're tracking that cohort, and then the fund will invest at the seed stage, which is, so we're doing a pre-seed investment when they initially come in. Then our goal is within 12 months, so 12 to 18 months, we're going to be doing their seed stage investment. And then we'll have that early liquidity for those investors who came in at that initial stage, at that pre-stage, that pre-seed round. But again, it really comes down to, our whole process is driven by getting to know these founders, because we're investors. It's part of that community process that we mentioned, where we're really trying to build community around them to kind of help and de-risk the investment. So I think that's like really kind of what the goal is for us. It's we're working with them, getting them what they need to move them through each stage so that we can actually, ultimately invest.
Yeah, for sure. And I would just add to that, there's there's typically two things that a startup requests at the pre-seed stage. One, they want as many introductions as possible. And I'm sure anyone who's interacted with a startup has experienced this. The list of introductions that they like is massive, and then they want capital, right? So this is a way, if we're doing a focused accelerator cohort on a vertical where we can get leverage. We have 5 companies that are clustered in an area like green building tech, and we can bring in an owner or developer who is essentially in charge for the facilities of these buildings, and hear all 5 pitches, and we can bring in 20 of those same personas of the developers and owners for those startups. Like, we get a lot of scale with that. So that's way easier for us than just making one-off introductions for dozens of startups. So that's another reason. Like, again, for us, it's like swallowing our own medicine. We want to make sure we're thinking about scale and leveraging tech, in the form of virtual communication to do that. So, Shafiq, I don't know if you want to take it from here, but I see a couple questions.
Yeah, I was going to say, Hashmi Saib, I'd love to, invite you to ask your question as well. Mr. Hashmi is part of Pakistan's Foreign Service. He's the Consular General here for Pakistan in Houston. They're actually going to be, looking at the ways to help encourage and innovate and, startups, the startup ecosystem, and how that can come to bear for Pakistan as well. One of the interesting points you had shared, Hashmi Saab, is that Pakistan as well, one of its upcoming challenges is going to be related to meeting its overall, housing demand itself that the country is going to require over the coming decades. And I'd love to, give you the opportunity to ask your question, or I can ask it for you as well. I saw you were able to unmute. Would you like to ask your question, or I'm happy to do it for you? Well, Nick here, I mean, I think, going to the question here in the chat is, how do you see the ROI in the future in green industries? I think when we talk about some of the harder technologies, when we're looking at construction, transportation, or hospitality.
Yeah, well, I like this question a lot, because this is, I think this is a misconception that green industries and clean tech and climate tech doesn't produce a great ROI for investors. It's more, if you're going to invest in these companies, it's for impact investing, and like maybe you'll make a little, a little bit of profit. But the reality is, the one thing you need to be aware, the reality is that these can be great venture investments. So deep tech, hardcore technology companies, true product companies, and by the way, how we kind of label that is if you are, if we give you $1 million, where are you spending that money? Are you hiring salespeople? Are you hiring marketing people? Are you hiring engineers? The true technology companies are just adding to their engineering force, right? They're just, I mean, they don't need people, right? To a certain degree. Anastasia and I are both sales and come from a sales and marketing background, so we're like kind of throwing ourselves under the bus here, but largely, like, that is the that's kind of how we think about one discovering if they're a true tech company. But they can produce great venture returns, one, because their margins are fantastic. So when you're talking about getting to profitability, getting to break even, it's a little bit easier to do that when you when you don't have a ton of overhead, when you have a ton of people and on payroll to pay for, much harder to actually get to profitability. So that's an interesting piece. I think the other variable is, again, I mentioned this earlier, the return multiples that you're going to get from true tech companies that have, again, a large engineering force. They've built something very defensible. You can't just go create it. You can't, do it in a hackathon on the weekend, over the weekend, and it's essentially very, very defensible and technically sound. So companies will overpay, acquirers will overpay for those sorts of technology businesses. So they can be very, very attractive investments. The one thing I'll say, and I think you're kind of getting at this with your question, is you do, any deep tech, hardcore technology company, there's a little bit of capital intensiveness that you need to be aware of. Sometimes they require, for instance, our 3D printed housing investment, Icon, they've raised to date, I think to date, it's probably well over $50-60 million, and they're not even to their Series B yet. It's just a very capital intensive business when you think about what they're trying to do. And so from an ROI perspective, every time they do a new round and we don't fill our pro rata, we get diluted. So we got to be aware of that. The time horizon for them to actually get to market ends up being a bit longer. The deeper tech solutions too. There's also there's little, because they're still building product, there's a little time for them to get real time tangible market feedback. So sometimes it feels like they're building in a vacuum, which can be dangerous from a product perspective. So there are things to look for. Like it's sometimes much harder to have a successful deep tech investment. But when you do have a successful one, it's a huge home run. So those are some of the warning signals, I think, Mr. Hashmi, that we would look for if we're making an investment like that.
Nice. And then also, one of the things when I was that was really exciting when you were sharing, I think, is how you guys are taking a much more open or enabling access into opportunity as well. And so there's a variety of different ways to, partner or participate with you. Of course, there's at the fund level. And you guys had also mentioned that, you're bringing sort of like a crowdsourcing approach to your accelerator-based funding and program. And it'd be great to hear about some of those opportunities and how you guys are going about that.
Yeah. Well, thanks for that question. So you mentioned, so we kind of have 3 product lines at Shadow, where if you're interested in participating, you can. The first I'll just mention is our fund. So that's basically the deck I walk through. Accredited investors only can participate in the fund. It's a $15 million fund, and we're roughly 14 million raised. So we're at the tail end, and we close in March. So it's a little bit of a short time horizon.
Congratulations on that, by the way.
Oh, thanks. Yeah.
Yeah. That's exciting.
Yeah, very, very exciting. We'll start deploying the money, which is the best part of being a VC. So yeah, our fund is open. So if anyone's interested, let me know. Just keep in mind the time horizon is pretty short. We also syndicate out all of our fund investments. So anytime, if you're looking to be an angel, you can join our investment platform for free, and we will send you deals that we're doing out of our fund. There's a fee associated if you don't join the fund to participate in those deals. But nonetheless, we provide a pretty strong deal sourcing flow for people who are invested in this industry. And then the accelerator program, which is the kind of the crowdsourcing piece you mentioned. We wanted to make the accelerator program a little different from the syndicates and the fund. We're about democratizing venture investing. We think the world should have access to investing in private tech companies. It's proven to be a fantastic investment opportunity. So usually the barrier to participate, one is accreditation. So there's actually legal implications that will prevent an individual making less than a certain dollar amount in income for participating. That's largely being lifted. The SEC has made kind of new exemptions to allow for more participation. But the second piece is check size. So usually to participate in a serious opportunity as an angel, unless you know the founders or something, you have to write upwards of $25K, $50K check to be taken seriously. And for a lot of people, even if you're accredited, that can seem like a large amount to invest in one particular startup. So if you're going to angel invest, you typically want to diversify your portfolio because it's a risky endeavor. So our goal is we've decreased the minimum. If you participate in our accelerator program, the minimum check size is $1,000. So we think that's a pretty reasonable price point for a lot of professionals. And again, the goal is to democratize and get people started with venture. Once you have a taste of it and understand it better through doing it, we think more capital will come in and obviously great returns for investors who are participating and doing it the right way. But to anyone who's new and is interested in learning more about that, Anastasia and I are happy to chat. Again, $1,000 minimum to participate. You actually have the choice to we'll select 5 companies in the accelerator program to participate, and you have the choice to invest in one company or all 5, which I think is a unique thing too.
Yeah, it is. I mean, I think that was one of the things that I found really amazing is how you want to open and enable that access. And not only that, but providing optionality, because even once you do get the access, usually you're fixed in what you're able to do. There's fixed terms, fixed structures, et cetera. And you're just allowing for so much dynamics and flexibility in that, which is really amazing. And most investors are not offering anything close to that from a VC perspective.
Yeah, for sure. Appreciate you saying that.
Yeah, absolutely. I know I'm personally interested on the accelerator side, so I will be in touch. And then the one of the things that I wanted to ask as well is like, what's the best way for people to get in touch with you guys?
Yeah, I think email is probably best for both Anastasia and I. I'll drop them into the chat here.
Yeah, that'd be great.
You're already on it? Sweet.
Yeah, I got you.
And of course, you guys can reach out to me as well, and I can facilitate the access over to Nick and Anastasia. And then, their information is available on their website and through LinkedIn as well.
Yeah, absolutely.
Nice.
I just want to say too, thank
Please.
you all so much for having us. We're honored that we've been asked to come speak here, and I think what your organization is doing in terms of education around innovation and tech is awesome. It's needed in a lot of different cultures, chapters, different geographies here in the U.S. and it's awesome what you're building. So thank you again for the time.
Absolutely, and thanks for joining us. Thanks for sharing insights and knowledge. You guys clearly know a lot and are bringing a very sophisticated approach to how you think about and are investing in the built environment, and also just creating opportunity for you guys yourselves within your own firm, but then also for others, which is just really exciting and really incredible.
Thank you.
Thank you so much.
Yeah, absolutely. Thank you very much. Thanks to Nick and Anastasia, and thanks all for joining us today.
All right, guys.
Cheers.
See you later.
Bye.